Hello everyone and welcome to one of our knowledge transfer sessions. Today we're going to be talking about the topic of an immediate annuity. This is one of the interesting topics. Something's always stuck in my mind when I talk about retirement products. When I first started in college a long time ago, I remember reading articles about all sorts of financial products. I mean, you can probably see why I'm a financial planner today, because even then I was reading about financial solutions. And I remember reading a CNN article. There was like a money guy, and I've always tried to go back and look and find this person. And it was one of those old school Q&A where you ask questions from a financial professional and they give you answers. And I remember them talking about this concept of taking a portion of your retirement and buying an income stream from an immediate annuity, and then taking the rest of your retirement and letting it ride and grow it in the market. And you'd have this basic protection against market risk because you would have a income plan that would replace pensions. And at that time, in the early 2000s, pensions were being heavily eroded, and we had really moved to the 401k system here in the United States. So how you would replace that pension, or the three-legged stool, was actually a major financial topic to talk about. And so I always remembered about immediate annuities throughout college, training, becoming a financial professional, everything. And when I finally got my career going, I found out that immediate annuities are pretty fundamental to the retirement services industry and actually rarely used, which was interesting, I found. So I figured I'd talk today about the old school classic immediate annuity and some of the hatred around this as well. So when we talk about any financial topics, recognize we're trying to summarize complex information that could be different for every person, how it affects them. So just recognize today's presentation has to be treated as general in nature, because you can't exactly perfectly explain a financial concept without massive disclosures, and we can't do that for this type of presentation. A little bit about myself. I have more than 18 years experience in the financial services industry, mainly in Washington State. I've worked for a bank. I've worked for an insurance company, which is very pursuant to today. I've worked selling mutual funds to people just right out of college, and I've been a financial professional and a financial planner for more than 10 years at this point. So what we're going to do today is we're going to understand the concept of immediate annuity. What was I talking about there? That concept of when I was first in college that really grabbed onto me. Then we'll compare this to alternatives, other things you could do yourself. Then we'll talk about the hate. Commission as emotion is the big thing around that. And then we're going to go from there. Is this a good idea or not? So let's talk about the concept of the immediate annuity. What we're talking about today. So remember, when I say the word annuity, that word is meaningless. You always need to use other descriptors to really describe what you're talking about. And so an immediate annuity is something that you give an insurance company a lump sum of money, so it's not deferred, and they will start income stream for you within a year, basically. And if you compare it to the rest of the industry, most of the rest of what you're going to read about are what are called deferred annuities, with maybe riders that will describe for income. But immediate annuity is a very specific style of insurance product. And if you go to a financial professional who actually understands annuities, they'll understand pretty much exactly what you're talking about if you use the word immediate annuity. And the word immediate annuity the word annuity comes from the Roman word annua. The Romans were the first to really come up with the idea of life expectancy tables. So it's pretty important that we kind of even go back to the old school days of this concept's been around a really long time. Really, the first time we see this used as a concept where you give someone a lump sum of money in exchange for an income stream was this idea called the tontine. That was in France in the 17th century. And the U.S., we can kind of see annuities kind of start in the early 1700s or the mid 1700s, but really overall in the United States, we don't really get into annuities heavily until the Great Depression because of the bank failures that kind of pushed people towards using insurance products at that time. So let's talk about the basic idea. What is an immediate annuity? So the basic idea, you have $100,000 in your hand, and you can do whatever you want with it. You can invest it, you can go spend it, whatever you want. In this case, what you're doing is you're going to take $100,000 and you're going to give it to an insurance company, and poof, your $100,000 is gone. And people hate that. And what happens then is that the insurance company takes your $100,000, they take the investment risk, you don't, And they will hand you a piece of paper back, a contract specifically, saying that they will pay you the rest of your life a certain amount of money based upon the features you purchased. In this example right here, I have someone who's deposited $100,000 and they're age 65, they're a man, and they will get $6,900 back every year for the rest of their life, no matter how long they live or how soon they die. Now, one of the natural questions you can have, well, what happens if I die right after I buy it? Well, if you choose the single life option, payments stop. You fundamentally made a bet with the insurance company that you were going to live a certain amount of time, and you didn't win on this portion of your money. Now, there are other options you can do. A period certain option is it just pays for that period of time and then stops. So in this case, 20 years, and then the payments stop. Single life with something means that it's going to pay the rest of your life, but if you die early, these things are going to kick in. So 10 year or 15 years means you will be guaranteed at least 15 years of payments, but it also will pay for the rest of your life. So if you die, say in year 10, it keeps paying 5 more years. Installment and cash refund are a refund of your principal or your purchase price minus withdrawals. Installment means it just keeps the payments going until it exhausts that purchase price. And cash refunds means your heirs get a lump sum of the $100,000 minus the payments you've been doing so far. And this is really simple, actually. You take a chunk of money, you run a quote, and you see how much you get out under what options you want to choose. Okay, and because it's so simple, it can be easy to overthink it, actually, but it's pretty simple. It just take a piece of money, poof, it's gone, and you're getting an income stream. Now, you can add on here another life. Like in my wife's and I example, we're married, and so if I were to buy one of these, I might do what's called a joint life, where it's going to pay for both mine and my wife's life. And whoever dies first, payments don't stop. Payments don't stop until the second person dies. And you'll see this is a lot less money, actually, than the previous example, because the insurance company knows that you're going to, at least in my wife and I's case, one of us is probably going to live a lot longer. Remember that actuarial math the Romans created? Well, this is what we're using right here. And you'll notice the period certain amount is basically the exact same number. And then you can also do joint life with refund options. You'll notice the refund options don't do very much for you because statistically speaking, when there's 2 people involved, the odds of one person dying early, that happens. But the odds of both people dying early, not very likely, typically. And so when you get down to the basis of this, you just have to take a chunk of money and go, well, I want to look at this. I want to see how much I can get for the rest of my life. And what's going to factor into your quote of what the basis idea is going to be lifetime options. Are you going to have this pay you for life or for a period of 10, 15 years? Are you going to add a second person to this? Because that does affect the payment price. Are you going to add death benefits? I find most people do try and add some sort of death benefit. They don't like the life-only option. I personally like the life-only option the best, but I never win it in discussions. So I'll mention that most people do get some type of refund option, I find. You will have the option to add this thing called a cost of living adjustment to these contracts. And this is the one I would suggest you not do unless it's just automatically included for some reason. And the reason is because annuities behind the scenes are fundamentally using fixed interest rate products to construct them. And when you try and do a payout plus a cost of living adjustment, it makes it very, very expensive, and it kills the payout so much that it's not worth it. A cost of living adjustment, for those who don't know, is let's say something's paying you $1,000 a year. Well, the next year it would pay you $1,020. It would go up 2%. It would go up 2% every year until you stop getting payments. And on the outside, that sounds like an amazing deal, right? I definitely want my payments to increase because inflation's a problem for most of us. But if you ever do the math on it, you'll find that adding a cost of living adjustment is so expensive that it doesn't really make sense. You usually want to use, the reason why you don't want to put all your money in an annuity like this is because of the inflation problem. The payments don't typically increase. But the idea also is that because you have this guaranteed income stream, you can take reasonable full market risk with the rest of your investments to combat the inflation piece of this, basically. Payouts can be affected by the company chosen, and then interest rates prior to initiating the contract. Because if you watch this video today, a year from now, let's say interest rates go down 1 or 2%, at the Fed's level, you're going to find these products are fundamentally worse than they are today. So once you lock it in, you're locked in. But until then, the quotes are only valid for so long. Now, remember, fundamentally here we're talking about buying insurance. And I run this problem all the time when I show someone a payout rate where it's like 7%. And they're like, well, I'm making 7% on my money. No, you're getting paid 7% of your money. This isn't really an investment or an asset. This is insurance. It's the exact opposite of life insurance, in fact. Like if you ever think about term life insurance, or really whole life's the better example. Let's say you're paying $10,000 a year for $1 million of whole life coverage. At the end of the day, you're paying $10,000 to get $1 million. With an annuity, you're taking your $1 million and then you're getting $10,000 for the rest of your life. It's the exact opposite equation, actually. But because it's insurance, you have to consider the ideas of what happens if you die early. What if we have out-of-control inflation? You have to also consider the fact that, you might be more of an investment style person. The guarantee may not be important to you. So, what if you could do better on investing than the insurance company? I mentioned they're building these fixed interest rates. What if you're buying the S&P 500? And then what happens if the insurance company fails, right? We always have to consider that. It's pretty rare for a highly rated insurance company to ever fail, but it's in theory very possible. So we need to talk about that as a concept. The other thing when we're talking about immediate annuities you want to watch out for is they look very similar to pensions. And if you model this in financial planning software, it's very similar. Now, I'm in Washington State, and I get to see the public employees pension a lot. And I'll tell you that if you compare the public employees pension to an annuity, the public employees pension basically has like the cost of living adjustment added for free, which is really expensive. And so I find that they're like 20 to 30% better than a insurance company annuity. And the thing I said there is that insurance company annuities are technically based upon the insurance company, but it is a contractual guarantee. Whereas a pension isn't necessarily a guarantee, interestingly enough. It's guaranteed by, say, an employer because it's employer-based, but a public pension, as an example, isn't technically guaranteed. The government can always raise taxes, but that gets a little sticky on what they'll do there. And you can kind of look at Chicago as an example of where pensions may not be as guaranteed. Now, I use this word guarantee. In the financial services industry, guarantee is a pretty sacred word because it's really strong emotionally, actually. It's one of those things that you can misconstrue. It can create lots of problems from a compliance standpoint. But when we talk about an immediate annuity, it has the word guarantee in there because it's guaranteed by the claims paying ability of the insurance company. And when we talk about retirement planning for someone, there's really kind of two concepts. Are we trying to guarantee things for you? Or are we going to be doing more probability-based model where we know that there's a more than reasonable chance that a model is going to work and grow your money and provide income to you, but it's not guaranteed, right? There's no contractual guarantee there. And so when we talk about that concept, we need to talk about a non-guaranteed model, what a lot of other retirees do, what I call a probability-based model. And let's talk about this basic idea of an endowment concept. An endowment is done by a public institution, like a university. And it's where they have their big pool of money and they live off of it as part of their institution. And their goal is actually to never decrease that pot. They actually want to grow it by a certain amount each year and get money out of it. And so Harvard's very nice to put out there kind of what they do. And what they would point out is that they have an endowment fund that they target 8% rate of return. So they can give themselves 5%, and 3% gets put back into the fund to grow it, basically. And over recently, they've actually achieved 9.3%. And that's really good. And so this is something you could do yourself instead of buying an annuity. Now, annuity pays higher than the 5%. So pay attention to that because there's a material difference here. But you could try and replicate something like this based upon your investing capabilities. And in the financial services industry, we do attempt to replicate this in all sorts of different ways. Recognize Harvard, they're using hedge funds, private equity. They're using things you probably don't have access to unless you have more than $10 million of assets. But it's possible, basically, for you to replicate even what they're doing if you have that asset amount. But if you're going to do this yourself, if you're going to go more of a probability-based model, and that's like where you buy a target date fund for yourself, and you're trying to generate income for the rest of your life. If you want to compare this to an immediate annuity, we have to talk about some things you have to model or guess about as part of your process. And one of the big things you want to think about here is this idea of how long you're going to live for, right? It's intrinsic to the immediate annuity conversation, but it's also true on the probability model conversation, because, right, we have to figure out, is there a reasonable chance that your money will last based upon basic modeling for you? And then once you figure out your life expectancy, if you're trying to model an alternative to the immediate annuity, because remember, you can just buy this and you don't have to do this, you have to also kind of figure out what rate of return should be planning for. And, I really like the S&P 500 as an investment. So sometimes I'm trashing it for retirees, something I think is really good. But one of the problems you're going to run into as retirees, you're probably not going to put all your money in the S&P 500. And so it means you probably can't model based upon this. And so I'll show you a model using it. But, a lot of times you're going to look at a target date fund or a balanced fund, or you're going to look at some type of diversification plan, which means you need to figure out what the rate of return is going to be potentially for that plan. And then you need to look at volatility, because the Harvard plan, if you look at their endowment, they're really targeting a rate of return, and they're rock stars. I bet you their internal numbers for their standard deviation is actually really good as compared to what you can do, because they have access to more institutional investments. But when you do this yourself, you have to look at your rate of return, and then you have to think about the fluctuation around that rate of return, right? How elastic do you need to be around your withdrawal rates based around this fluctuation? So if you do all this math, right, if you go into this and you go, well, I want to compare an immediate annuity to more of a probability-based model where I want to buy like a balanced fund. I want to keep my investments whole, which I find people really do want to keep their investments whole as their primary retirement style. What you can do here, and I used a system called Money Guide Pro, which is financial planning software, is you can go run an immediate annuity quote, and then you can go take $100,000 and you can put it in under a fund, and you can see, well, how would it do based upon a Monte Carlo scenario? And if they use their historical rates of return, because Money Guide Pro has some buttons you can click on here, you'd see that you have an 86% chance that the age of 92, you would still have your money around. And on the averages, if we talk just pure averages, this should not only match what the immediate annuity does from a payment perspective, but you should have almost $500,000 in the bank at the end of your life. And even if you choose a balanced fund, you're still going to replicate the immediate annuity payments, and you should have roughly $166,000 left. So when you first look at it, you're like, well, these other models just seem superior. And they could be. In fact, the majority of my business is actually more of these other models than the immediate annuity side. But there's always this problem when we talk about probability-based modeling of what happens if things change. What happens if the investment mix you chose is not the correct investment mix, because S&P 500 is starting to become pretty heavily weighted towards some certain tech companies. Well, what happens if they fail for a year or just have poor returns, or AI just doesn't take off, right? Or the tariffs cause problems. Like, there's all sorts of different things that can cause something to change. It just hasn't happened in recent history. And so if you model that as a solution, like, let's model some change. Let's model projected rates of return. That's just a button I click in Money Guide Pro. It's not me choosing anything in here other than clicking that one button. Well, that system would suggest there's only a 53% chance of success on the S&P 500 and a 43% chance of success on a balanced fund. And so you notice that if we model much lower rates of return for whatever reason, and then we add Monte Carlo scenarios around it, we start to see more points of failure based upon the immediate annuity. And so you have these two options, right? You can create this endowment style, which I think is more than reasonable, or you can go the immediate annuity route, which I also think is very reasonable because you're buying a guarantee. I don't find that people find the immediate annuity to be reasonable. And going back to those college days, I loved the idea of immediate annuity. I thought it was great. And then I found out people didn't really like this idea. And that was always interesting to me because I thought, like, well, it's something that spoke to me, before I knew anything, right? It was before I was even in my career. And so I was always in my mind been like, well, why is this never working the way I think it should? And if you look at LIMRA, they track annuity sales inside the United States. You'd see that immediate annuity is only about 3% of overall annuity sales in the United States. So sales numbers do reflect that this is not being sold very much. Something that's pretty fundamental to the math is fundamental to pension plans. It's used in life insurance. It's actuarial math. It solves a basic problem of you living too long. People aren't buying it. And it's this question of, well, why is that? What's getting in the way here? And there's a couple reasons I find people don't do this. And I'll go through some of the hate of this. Let's say you have $300,000 and it's part of your overall retirement portfolio. Let's say it's $700,000 that you have. And so you're going to give up $300,000 to get $21,000 of lifetime income, which is actually a pretty high number for recent history for annuities. Well, you don't have $300,000 anymore. You don't go to the bank anymore and see that you're worth $700,000. You go to the bank and see you're worth $400,000. And that emotional feel of giving up your cash, even if it makes total sense, it is really challenging for people when there are other options they could potentially do. So even though mathematically, Monte Carlo scenario, financial planning software, this could be a strong argument, that might not be enough for you. You are giving up your money, and it's just you're not seeing it anymore. And mathematically, in theory, you could take the remaining $400,000, take more equity-based market risk, and grow it faster. But people don't always see that as a good model for them. And then I said $700,000. What if you only had $500,000? You couldn't even give $300,000 to this annuity solution. It would not be what's called suitable. And so you have to have enough money to buy an immediate annuity. And when we talk about the retirement savings crisis in the United States, a lot of people just don't have the money to buy this as part of their plan. They actually should consider doing the probability model or an asset allocation model because that's more suitable for when you have less money and less savings, basically. It doesn't lock it up as much. And then you have all the other components, emotional components of what happens if you die early. I had someone come in my office and their primary worries, because when you ask them what you're worried about, and they're like, well, I'm worried I'm going to live too long. I'm worried I'm going to outlive my money, and I want a simple retirement solution. I'm like, okay, well, here's an option for you. It's simple. It solves those problems. And their first question to me was, they're like, well, I'm worried I'm going to die early now. It was really interesting. They went from my primary concern was living too long and outliving my money, which literally screams looking at the solution, to what happens if I die early. And that became their new fear. It was interesting watching that process go through them. And every one of those people usually do is called the break-even math. They figure out how long it's going to take them to make this break-even as a payment stream for them. There is one other problem. This is where I'm going to cause some drama in the industry in general. I do insurance brokerage, which means I can sell fixed insurance products for commission. But I also run an advisory practice where I can do what's called fee for advice under the fiduciary standard. And I'll tell you, I typically make more money when I do the second model, when I do a probability-based model, than when I do an immediate annuity model. And if you look at the commissions here for a product that might be hard to sell, there are other products that do similar things that probably don't model quite as well as an immediate annuity, to be honest, but pay double the revenue. And when we talk about the industry as a whole, and when you think about your average firm is a big firm that, if they're allowing their people to sell annuities, they have to cover the HR department, they have to cover marketing expense, they have to cover budget, they have to pay payroll. Well, they don't necessarily want that 4% commission. They probably want the 8% commission, just as their basic budgeting for the firm. And then we look at advisory fees, like the classic models charging somewhere between 0.5% to 1% of a client's portfolio every year. Well, if I'm doing that for 20-ish years and I'm potentially growing your money, I'm going to make way more than doing an immediate annuity. And I'm going to have recurring revenue, and I'm going to have a book of business I can sell to a third party someday. And then let's say I did a flat planning fee. And exactly what you pay for flat planning fees is usually more regional based, cost of living in a region. But if you look at a flat planning arrangement, if you do it for enough years, After about year 3 or 4, that starts to be more expensive than buying this immediate annuity. So I think there's actually a real conflict of interest with immediate annuities in that almost every other solution makes more money, and this is a one-off. You buy it and you're done forever. I think that's a problem of conflict of interest, and that's another reason why I think it's hated, not just because people hate it, but because professionals hate it. Now here's a question. Is this a good idea? Well, I talked about the probability model versus a more guarantee model. Everyone has a different philosophy of how they want their retirement to go. And so what I always tell people is that, you kind of have to figure out what path feels most comfortable to you, because the math is probably going to work in most cases. And when we talk about an immediate annuity, there's some things you got to get around. Your liquidity, when you put some money in there, you're not really going to be able to touch your money anymore. And there's a lot of emotional baggage around giving up your money. And you need to have saved enough money to even do the solution, it makes it another challenge. And then if you look at the S&P 500 for the past 20 years, there's a reasonable chance that you could, if it repeats itself, that you could beat the annuity over the long term. So that's kind of interesting. And if you go to interact with insurance agents to look at the solution, because of the conflict of interest around fees, you might even get offered this solution. So this is not perfect. There's challenges here you have to kind of get around. And you can do this endowment concept, and I find people tend to lean more towards the endowment concept. But when you look at the endowment concept, when you look at your capabilities to do that endowment concept, you run into a basic problem that your alternatives, things are easy enough for you to buy, don't actually replicate what those endowments are doing, at least rates of return and volatility wise. And so even though you can do that, most people I think try to do that, your investing capability for a more moderate portfolio suggests that probably the immediate annuity would be better because of the way fixed income works in kind of the mass market sense at this point. Because you could do this yourself. You can go buy your standard index funds, right? Your standard low-cost index funds, and do one single transaction with an insurance agent and buy an immediate annuity. And that's a very sufficient retirement model for a lot of different people. Because now you have potentially Social Security, annuity, and you can kind of let the market ride ups or downs because you've covered your basic income needs along the way. So our suggestion when you look at this, is this a good idea or not? We prefer process and not product. And this is just a tool. And the reason why we say process and not product is because there's different retirement styles I think people should explore that are beyond just annuities. And it's just good to kind of get a sense of, are you more of the guarantee style, or do you want more probable, like you've bought into the probabilities, basically, models. So exploring this is a good idea because your emotions really matter. Don't ignore the tax efficiency of these immediate annuities. They're typically very tax efficient. They automatically qualify for required minimum distributions. They dribble the money out over your lifetime, which typically is the most efficient way to do it, all automated for you. So they can be very tax efficient. Also, if you decide to go the annuity route, make sure you comparison shop. I own a brokerage agency, so remember I earn commissions on insurance products. And I'll tell you that, I run grids and grids of these products all the time, and they're fairly commodity products, meaning you can look at 20 companies at the exact same time, and there's very little difference between them. So whichever one pays you the best or is the cheapest is the best option. And that's usually thousands of dollars in your favor. So definitely comparison shop, because I've never had anyone turn down thousands of dollars, basically. So I hope this is helpful. We explored the concept of immediate annuity and kind of some of the retirement plan concepts around that. We just have a couple more videos on annuities before we switch topics to the S&P 500. So I hope this was helpful, but if you ever want to bug us, you're welcome to email us or give us your thoughts on finance. And I hope that you have a good rest of your day. Thank you.